Welcome to Saxo's Monday morning market call. And I will start with the big picture. The tug of war between inflation concerns and recession fears seem to be now tilting more towards recession. We had a coordinated slowdown in global PMIs last week, so that has kind of accelerated concerns of a global economic slowdown. And markets have actually started to assume that we will see a recession next year and Fed will ease. And that's why there was some respite in the markets last week. Global defensives have been in high demand, particularly. But just to give the right perspective here, H1 2022 is still looking like it's on track to be the worst first half since 1970. The Fed is still quite hawkish. Chairman Powell gave his testimony last week, and although he kept all options open, even 100 basis points of rate hike wasn't ruled out. So markets now have this double whammy effect where the Fed is tightening and there's a possibility of a slowdown in economic momentum, which is also, gaining a lot of focus. So that has meant that bonds could become relevant again as a tool for portfolio diversification after the early part of the year has seen a coordinated sell-off in equities and in bonds. What's more important for this coming week is that it's month end, quarter end. So that could mean a lot of rebalancing and that could mean gains in stock markets. Probably the last couple of weeks before Q2 earnings begin in mid-July. And that would be certainly a big disappointment given the cost pressures that we've been seeing. And now we're also seeing the consumer side of the equation weakening. We had the University of Michigan 5-year inflation expectations revised down on Friday. This is now at 3.1% from preliminary reading of 3.3%. And why this is important is because Fed Chairman Powell actually cited the jump in inflation expectations as a big reason why the FOMC moved by 75 basis points in June rather than 50. Now it's been revised lower to where it has been for most part of this year, which also helped markets on Friday, particularly because the odds of a 50 basis points rate hike for July have jumped higher again. Still, as I said, the Fed's hawkish rhetoric is also still pretty strong. We had one of the Fed speakers, Bullard, on Friday. He particularly is one of the most hawkish Fed members, and he reaffirmed his call for front-loaded hikes to 3.5% by year-end. He believes U.S. economy is still strong. I don't know how he sees that. Probably still living in denial. But it's something to watch how the Fed speakers continue to be pretty hawkish despite the data disappointments that we are seeing on the eco side in the US particularly, and of course Europe as well. What is, I think in terms of data, what is key to watch for the US will be the housing market. Even though Friday's new home sales was up, higher mortgage rates mean that demand may weaken. Inventory is actually falling very sharply as well, which likely risks a property market meltdown. So I think important to watch pending home sales data, which is due in the US hours today. But still, bigger focus will be on the PCE data on Thursday, which is what the Fed kind of looks at to gauge the inflation expectations as well. And we have ISM manufacturing survey on Friday from the US, which again I think should confirm the global slowdown in PMIs that we saw last week. And we have a lot of Fed speakers who will continue to possibly raise the bar of hawkishness. But what the markets will be looking out for is any hints of recession in the Fed talk, which should actually again help the markets to rally as Fed easing expectations will build up. In the FX side, trading was relatively more subdued over the last week, and there's little data of interest in the coming week as well. So overall, ranges have been pretty tight, and that certainly is giving me some feels about subdued summer trading ahead. But let's be reminded again, this is really the calm before the storm. Especially for yen, which has been range bound. But I think one of the key developments we had last week was the ex-official who was actually responsible for intervention, hinting at a possibility of a unilateral intervention in the yen. So there is still a risk of a sharp reversal there, and we would kind of continue to caution clients against any uncovered positions. in the yen particularly. And just a quick summary for the commodity prices also, which took a big hit last week, broad-based losses across metals, energy, and agriculture space. So while some of this froth is being taken out of the commodity markets, we still do not think that there's enough reason to reconsider our bullish commodities call over the medium or long term. And we did see crude oil was a little bit firmer on Friday, and supply constraints kind of still hint at price pressures picking up in the medium term. So overall, our thinking is that the level of potential demand destruction that the markets have now started to price in is still quite unclear. We don't think there will be a huge end impact, not substantial at least, to kind of change our long-term bullish view on commodities, not for now. The interesting, I think commodity space will still be very interesting to watch this week, but I'll just highlight gold, which has been pretty range bound despite expectations of a recession picking up. But now over the weekend, we had a news that G7 is banning imports of Russian gold. So there is potential for gold to, break out of the current range. That's it from me, and I'll pass on to Redmond now.
And in China, Hong Kong, and last week, CSI 300 up 2%, and Hang Seng up 3%, and Hang Seng Tech up 4%. And this is basically is still keep. I think still quite a bit of investor interest, given position is still light on China, and also given the overall outperformance. Not so much last week because it's the US actually catch up last week, but since the mid-March low, and I mean, we have seen a very strong rebound in MSCI China up 26%, and CSI 300 up 16% from the March low, and Hang Seng up 19%, and Tech's all up almost, Hang Seng Tech up almost 40%. So, I mean, towards quarter end, and when investors, if their position are still light, and they probably need to catch up in rebalance the portfolio and allocating some to China. And then we actually have been seeing the sentiment have greatly improved, and because they tend to look at news with more favorable light, and more favorable light. For example, last week when President Xi mentioned in the BRICS business forums, saying that will strive to achieve the full year social and economic targets. I mean, he actually did not specify what kind of a growth target or economic target he has in mind, and he has not really specified that is referring to the 5.5 GDP growth target, just very general. But the market take it as is more policy will come to help boost the economy. So I think that is actually quite that seems the analysts and investor really want to look at it more on the positive side, right? And then also his comments in another meeting in mentioning about supporting platform enterprises to service the real economy. And actually, he only say one sentence, and then the rest of the read out from the meeting actually is more talking about enhancing regulations on platform economy. So, but the market and analysts still cite that as more as a positive comment, and expecting more relaxation on regulation, which I tend to leave bit skeptical. But I mean the market, but it tells. I think the reason I bring that up is it tend to it basically is give us some idea that the markets really want to be quite positive. Sentiment has improved, and also one unlocks is that China will enact we revise the version of the anti-monopoly law. I think will be enacted on the 1st of August, and we haven't really seen the full document yet. Another thing is the National Health Commission last week announced, say that they will forbid local government to add unauthorized lockdown measures. So that is positive, because there's always incentive for local government to put on some additional measure for pandemic control for political or whatever reason, and that actually National Health Commission now prohibit them to do so. That would be good, and for the resumption of a business operation. And last week, we have the emerging industry PMI in China that we bound to expansionary territory, and this week we have more important number coming out. and the official PMI and manufacturing PMI and non-manufacturing PMI. And now the street economists are expecting both will bounce back to above 50, i.e. Back to expansionary territory. And so that will help. If it came out as expected, probably that will still contribute and help sentiment further. And then we have on Friday we have Caixin manufacturing PMI. Caixin is way more focused on smaller and private company, and that one and the Bloomberg consensus is still calling for a below 50 number, 49.4. But we have been seeing quite from some some economists from some other investment bank and so on. They're already expecting this data point will go above 50 and returning back to expansionary territory. So, I mean, while the US is still quite deep in a recession fear, and China overall the tone is more looking for some recovery from the reopening after the reopening. So, and that is that probably will still keep the outperformance in Chinese equities in the coming week. Having said that, I mean, because of the Fed is very hawkish, as Trevor mentioned earlier, the global equity market is under a lot of pressure and still in bear market. And when the global when the global market is in a bear market, it still will give some pressure on the Chinese equity market. And Chinese equity market, the growth is also whether it will be sustainable from here, whether there will actually be more policy coming, and it's still a question mark. So I think we will be seeing some relative outperformance in the coming days, but the market overall is still in a bear market and still have to be positioned. Still, we still advise clients to be very nimble and prudent in their positions. Thank you. That's all for me.
Good morning, everyone. My name is Jessica, and thank you, Redmond, and thank you, Charu, from the Sydney team. So I'll just be giving you a broad equity rundown. So complementing what we've already discussed so far, I wanted to talk about why volatility in equities is calming before the end of the half year, and that being 30 June. So we do have volatility as measured by the VIX, which is a measure of investor volatility or fear in the market. So I guess the gauge of fear has fallen by 21% from its June high, and it looks to be calming. And this coincides with end of quarter and end of half year rebalancing. And this has pushed the US benchmark, the S&P 500, and the tech-heavy Nasdaq into a technical uptrend on a daily level, so on the day charts. So what is rebalancing, which we touched upon earlier, and you've read that in our, or we've read it in our commentary. So rebalancing is where fund managers take profits from those assets that have done well this quarter, this half year, and this financial year in Australia, which comes to a close on Thursday. So those assets that have done the best across the baskets that we carry, that we track rather, include commodities, and in commodities specifically oil and grains have been some of the big outperformers. And the other equity basket that's done really well is defence. So we typically see fund managers taking profits from these areas around this time of year, and this will likely continue. And then they top up those asset classes that have fallen the most. And specifically, that's tech and property, because we know tech and property traditionally suffer as rates rise, and indeed we're heading to a higher rate cycle. So what are we saying? The S&P 500 and the Nasdaq are likely to rally up ahead of Thursday from a technical and a theoretical perspective, while in Australia, ahead of end of financial year, rebalancing may be heavier given we close off the financial year. However, the big picture still remains. Selling pressure is likely to resume, and volatility could pick up next week because we know that we are going to a growth slowdown. And if you do have a look at the big picture, the weekly and the monthly charts indicating the S&P 500 in the US, the Nasdaq 100 also in the US, and the ASX200 here in Australia are likely to head lower on a weekly and monthly level. Also at Saxo, we think that there is more downside ahead. And this is because we think that earnings estimates are way too optimistic. So buy-side analysts still have consensus or still have factored in that a lot of earnings growth is ahead. But we think next week when Q2 earnings or company Q2 earnings results are started to be released and they guide for the year ahead, we'll start to see the market get probably spooked and head lower again. So this is something to be mindful of. Also keep in mind we are grappling with tighter liquidity. Moving along, touching on BHP, I think what is really worthwhile to keep in mind is that BHP shares are in a bear market. Their shares are down 23%. And so BHP is the biggest commodity company in the world. And not only that, they are the biggest stock on the ASX. But we think there could be some opportunity for BHP to come out of a bear market, perhaps come out of hibernation this week. The reason that BHP is in a bear market is because the industrial commodities that they're so rich in, iron ore and copper, are both down considerably. However, today, both the iron ore price and copper prices have jumped up considerably. And I think this is part and parcel for a couple of reasons. Firstly, as we said, it's end of financial year in Australia, and BHP is down 16% this financial year in Australia. So we are likely to see fund managers and investment managers top up BHP positions, given it's the largest commodity stock and is the biggest stock on the ASX. Secondly, the technical indicators are also suggesting that BHP shares could be due for a rally up on the day charts. And thirdly, we did have good news at the weekend from China, the world's biggest commodity consumer, declaring victory, with Shanghai declaring victory from the COVID outbreak. And this is why the iron ore price is up almost 4% today and is likely to continue to rally up from a technical perspective. And the copper price has also jumped today for the first day in 4 days. However, we do think that we still are quite, I guess, a little bit cautious on BHP over the month. And we do think that we should keep on edge, awaiting for more signals, positive signs from China, and potential opportunities to buy for the longer term. I think that forward earnings growth still remain a question, and in Australia we'll get a better picture on what BHP's financial trajectory is like in August, when their financials are released. Also, just validating Charu's take on gold and our position on gold. There's a couple of gold stocks to look at, and we will put them in the spotlight document and also in the daily digest. Also rounding it out for the big picture, if you do have a look at the equity baskets that Saxo tracks, we can see that commodities are still the best performers year to date, followed by defence, but we are starting to see a pickup in renewable energy stocks, and this is part and parcel because we are seeing the technical indicators give off positive signals, and renewable energy, specifically lithium, has been sold down heavily and it is subject to end of quarter rebalancing. So that's pretty much it from the three of us today. Thank you very much for tuning in. We'll see you the same time, same place next Monday, but please keep in mind that all our research is available on the platform under Inspiration. For any questions, comments or feedback, please reach out to your Saxo RM or your Saxo GST. From Chiru, Redmond, and myself, have a wonderful Monday. Stay safe, happy trading, and happy investing.
And just a reminder that the recording of this call will be available on our YouTube channel. So also please don't forget to subscribe to Saxo Markets Singapore, Saxo Markets Australia, and also if you're interested in Cantonese, please subscribe to Saxo Markets Hong Kong channels as well. Thank you guys. Happy trading week. Have a great week ahead. Bye-bye.